Hello there. Welcome to The Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Prime Minister Mark Carney will visit China next week as the government tries to rebuild a relationship with the Asian superpower. Carney is set to meet with Chinese President Xi Jinping and will have discussions on trade, energy, agriculture, and international security. This would be the first trip to the country by a Canadian Prime Minister in more than 8 years. It comes after multiple rounds of tariffs and duties were imposed on different sectors by both countries. British Columbia Premier David Eby says Canada should prioritize building more oil refinery capacity over new pipelines. This comes as a response to Alberta Premier Danielle Smith's calls to expedite new pipeline infrastructure to the BC coast. Eby adds that the existing Trans Mountain pipeline is not at full capacity, and he says it could be expanded further. These remarks come, of course, amid a threat that Venezuelan oil could begin to displace Canadian crude in U.S. refineries. Toronto home sales fell 0.4% month over month in December, capping a year of lower buyer interest, partly as a result of economic uncertainty amid the trade standoff with the U.S. The benchmark price of a home fell 0.7% month over month. Annually, total sales slipped about 11%. Buyers failed to return to the market despite lower interest rates and more listings to choose from. New listings rose 5.5% month on month in December. U.S. futures is set for a pretty flat open this morning. The S&P 500 closed at a record high yesterday. And let's have a look at how Toronto traded yesterday. Our benchmark, also ended at a record high in trading yesterday. Look at that, up 29% excluding dividends in 12 months. Oil slipping despite the uncertainty over how much Venezuelan crude will be coming on the market. The overall backdrop seems bearish amid fears of a glut. And let's see how gold has been doing. It's seeing something of a setback today, dropping almost 1%. And finally, Bitcoin. Let's have a look at the biggest crypto. And Canadian dollar. Sorry, I jumped ahead too fast there. The Canadian dollar holding steady at almost 72.5 cents. And let's have a look at Bitcoin, the biggest crypto. And it is under pressure again today. U.S. and Canadian stocks ending at record highs yesterday. But let's get more on that and plenty more topics. We're joined by Carl Shimada, Chief Market Strategist at Corpay. Carl, thanks very much indeed. Great to talk to you as ever. The market, the equity market, of course, not famous for being a very accurate economic predictor, but certainly stock market buyers feeling pretty good right now.
That's right. And the fun part now is that equity markets are, to some extent, helping to drive the economy. We know that, the stock holdings of the wealthiest households, even upper middle class households, have been rising dramatically over the last couple of years. That's powering, sort of an improvement in sentiment and convincing a lot of households to do the spending that's driving the economy. And so, you are sort of seeing a feedback loop developing between, equity markets going up and the economy outperforming. And clearly at this point in time, it does not look as if investors are turning bearish on the underlying economy, on corporate earnings, or on that sort of global risk backdrop that we've seen punctuated so many times in recent weeks.
We are fairly shortly going to get a decision on President Trump's trade tariffs from the U.S. Supreme Court. Is that likely to be a market-moving decision?
It's funny, it shouldn't be, because markets are anticipating the administration essentially immediately replacing all of the IEEPA tariffs with other tariffs under other laws. But the reality here is that that could be quite nuanced, because many of the other laws that are on the books that would allow the president to implement tariffs have big restrictions on the time and duration that they can be in place. They have restrictions on where they can be used and for and at what level. And so there's going to be some uncertainty as to exactly how those can be implemented and how they might be ruled over time. And then at the same time, what businesses do in reaction could be a trigger for a lot of movement, right? So we know that businesses are going to immediately start applying for refunds if this set of tariffs is struck down. And we know that if there is sort of any period between now and the next round of tariffs, that they are going to begin front running again. And so if we look at economic data and how markets have treated things over the last year and a half, we've seen repeated instances of volatility, right? Of businesses trying to get goods across borders before tariffs came in, then running down inventories, then doing it again. That transmitted into what markets were doing, and so what we might see here is a period of turbulence, even if it's if the underlying ruling is favorable for global trade.
You say there are serious long-term weaknesses apparent in the U.S. economy, even though right now things seem pretty strong economically, fueled by big deficits.
That's the thing. So, my view on the U.S. economy right now is that we are due a hawkish repricing and growth and monetary policy expectations. So I do think that we're going to see better than expected data in the first quarter and maybe through the first half of 2026. That could prop up U.S. yields. That could, push the expectations for rate cuts further into the future, and it could also, lift the dollar. But the other side of that is that in the longer run, clearly labor markets are rolling over. We are seeing a softness in terms of job creation over time. Much of the economy is being driven by government spending. Although, Mr. Trump came to power promising to reduce government deficits, they remain extremely, extremely large, on par with wartime. If we look at the drivers on the corporate side, as I'm sure everyone has said in recent months, the tech sector, the artificial intelligence plays themselves have been driving a huge share of growth. And so all of that to me means that we're sort of looking at an over-concentrated, fragile, vulnerable U.S. economy. And so over the longer run, like once we get past that repricing in the first half of 2026, we should see drag, beginning to grow and the U.S. economy narrowing its outperformance relative to other countries like Canada.
We're going to be talking to Deloitte later on the show. Dawn Desjardins, their economist, thinks that we will see lower economic growth in Canada this year, although there are some hopeful signs emerging. Lower growth this year compared to 2025. What's your broad thought on the Canadian economy, Carl?
I think that makes sense. I think the uncertainty that hit last year is going to have lagging effects. We are going to see that weak business investment, weak household consumption rolling over into other economic variables. I also think that the housing market is playing a big role here. The fact that prices are not going up as they once were, that credit growth has slowed so much, that is going to create a major sort of headwind for the Canadian economy. However, I do think that we should put all of that in the context of, last year at, just shortly after this time, most market participants, most economists thought that the Canadian economy would suffer much more dramatic consequences than it has. And so, to some extent, I think we've dodged a bullet, and we've also had a bit of a reality check about our place in the world and the vulnerabilities that we face on international markets.
Carl, we better go. Thank you very much indeed. Always great hearing from you, and I hope you can come back in 2026.
Indeed. I look forward to talking to you some more, Andy.
Carl Chamotta, Chief Market Strategist at Corpay. Coming up, we're going to get the latest on Venezuela and how the upheaval there is affecting the oil market and what could the impact be on Canadian producers. The Prime Minister says his government is working to expand access for Canadian oil in Asian markets, given the prospect of Venezuelan crude displacing Canadian oil in the U.S. market. Let's get more from Scott Hurst of CTV News. Scott.
Good morning, Andrew. The Prime Minister is facing increased pressure to ensure that Canadian oil and the Canadian oil industry remains competitive in the wake of the dramatic U.S. operation in Venezuela over the weekend. And this comes as U.S. President Donald Trump has announced that Venezuela will be providing some 30 to 50 million barrels of oil to the U.S. And he's also later this week planning to meet with top American oil executives to talk about plans to open up more access to Venezuela's vast but struggling oil industry. Now, by contrast, Andy, as it stands right now, Canada supplies about 4 million barrels a day of oil to the United States. But it is clear Donald Trump wants more access to Venezuelan oil reserves, estimated at about 17% of the world's total. Now, Canada's Prime Minister is signaling that he's ultimately not worried about U.S. plans for Venezuelan oil and saying that our energy sector will remain competitive. And also, Andy, going on to say that his government has been investing and doing much more to find more markets for Canadian oil, for that matter, Andy.
Give us a little more on the impact on people here with direct ties to Venezuela.
Andrew, of course, in the wake of the dramatic incident that the U.S. military went in to take out the Venezuelan dictator Nicolas Maduro and fly him to the U.S., there are the geopolitical ramifications and upheaval. And we've been focusing on the economic aspect and its impact on Canada. But of course, there are millions of personal stories, Venezuelans who have suffered under the Maduro regime, including a former judge who fled here to Canada to escape the Maduro regime with their family in 2017. Her name is Relenis Tovar, and speaking to CTV News, she says that she is celebrating the removal of a dictator that she describes as evil. But of course, there is concern that there are still some from the regime that remain in power. So there is cautious optimism, Andy, as we are hearing more and more personal stories from Venezuelans who have had to escape the brutal Maduro regime.
Scott, thank you very much indeed.
Thanks, Andrew.
Scott Hurst, our colleague at CTV News. Okay, Deloitte says 2026 will mark something of a turning point for the Canadian economy, but growth will be weaker this year than in 2025. We'll hear from Deloitte's chief economist in Canada after the break. It's been a rough year for Canadian economy with this uncertainty over trade. Of course, the worst of the damage was avoided, although big levies remain on steel, autos, lumber, parts of the auto industry and lumber. Our guest is cautiously optimistic that 2026 will see signs of improvement, but she says, or her analysis indicates, that the economy will grow more slowly this year than last year. Let's get more from Dawn Desjardins, chief economist at Deloitte Canada. Dawn, great to see you. Start off, if you would, with your GDP forecast for this year, because you do see a slowdown in 2026 versus last year.
Hi, yes, we do. We have a growth at about 1.5%, so a shade slower than in 2025 when it was 1.7. That's our estimate as well. I think what I'd say is that we think the first half will be slow. We're going to continue to operate under these extraordinarily uncertain conditions, but we do see reasons that we will see a strengthening in economic activity as we exit 2026 and head into 2027.
What are the brighter signs here?
Well, I think there's a few things. One is that although we're heading into the throes of it, we will have our review of the Canada-U.S.-Mexico trade agreement. Now, our baseline assumption is that we maintain our carve-outs for our exports to go relatively tariff-free south of the border. We still maintain in the forecast some of these heavy tariffs we're seeing on those industries you mentioned earlier. So that takes a little bit of shine off that. But we think that as we go through the review, while the deal might not look exactly as it does today, it will in large part allow us access to our largest trading partner. Additionally, we do think that interest rates will remain relatively low. We have the policy rate holding at 2.25% throughout the course of this year. And I guess when we think about all of the policies that governments across this country are trying to put into place, we think by and large we will see enough on that side of the equation that it will restore business confidence and that businesses will start to put some money to work.
Politicians love cutting ribbons and talking about infrastructure spending, and that's the real core of the government's economic policy right now. They haven't gone for big tax cuts, as you know. Do you think they're on the right track?
Well, certainly when we think about what will instigate some investment by Canadian businesses. Sure, taxes, a big issue. But when we look at other things that impeding their investment activity, we're seeing lots of red tape, as you say. So the elimination, or at least a significant reduction in some of those measures, I think will go some distance to helping businesses say, okay, we can get a return on our investment on a relatively good time. The other thing, as we know, is infrastructure. We need it. We need it to be improved so that our companies can get their goods to other markets outside of the U.S. timely and less costly.
Do you think there's a problem, though, that international business is going to be wary of Canada because of the trade threat? And also, I don't know if it's at the back of people's minds, President Trump's insulting remarks about Canadian sovereignty.
Well, I think if we're setting the stage to see investment and we start to see Canadian companies invest, that is going to show the world that, we are ready to build, we're ready to improve our productivity because we're willing to put our own money into our economy. And I think over time, and remember, none of this is going to happen quickly. We know that for sure. But if we start to see those pieces moving towards investment coming from Canadian companies, I do think that those opportunities will be seen by international investors as well. Again, we're not anticipating any huge, very rapid increase in investment. We do think it's going to take time. So as we exit this year and look to 2027, if we see some concrete improvement in some of these measures, that should, we think, be a catalyst for investment activity.
What about the labour market? Do you see much prospect, well, particularly for younger people who've had such trouble finding work?
Yeah, I mean, certainly when we're looking at the labour market right now, it is pretty soft. Companies are saying, sure, I may not be looking to reduce my workforce because we know population growth is slowing. We know that immigration is coming down significantly. But by the same token, not necessarily looking to add. So what's going to take to get them to really look at adding to the workforce? It will, in fact, I think, be this improvement in confidence, this sense that, yes, we're going to have access to the U.S. market. It's not going to be tariffed, and we will see demand for our goods continuing. So again, it's sort of a longer game. We're looking at the economy sort of in two halves, if you will. The first half is probably going to feel not that wonderful, but as we get through the review of the agreement, as we get to see some concrete results from government initiatives, we think these are the things that are going to turn sentiment, and we should start to see an improvement in the labor market conditions. But again, it's a bit of a time factor here.
Dawn, thank you very much indeed. Dawn Desjardins, Chief Economist at Deloitte Canada. Yesterday on Market Call, our guest was Matt Kacher, president of FSA Valuation Service, and his focus was North American stocks. His top ideas were Broadcom, Lululemon, that's a contrarian play, and Amatec, AME in New York. Today on the show, it's Jamie Murray of Murray Wealth Group, the focus, North American equities. Let's have a look at how major Asian markets traded today. There are some concerns about overheating in stocks, and you can see there was selling across the big bourses. Let's have a look at European markets now. They are also trading near record highs, or some of them actually are at new highs. So it was a mixed showing today, a reasonable rally for the German benchmark index. And let's have a look at U.S. futures as we count down to the opening bell. The S&P ended at a record high yesterday. It looks as though it's going to be flat at the open today. And one stock we're watching is called Ventyx. Eli Lilly is said to be in advanced talks to acquire Ventyx Biosciences for more than $1 billion US. Look at that. That stock moving up more than 50%. Let's have a look now at gold, because we saw some selling in gold earlier today, and you can see it is slipping in trading today. What a run it's had. Maybe we can just put up the US dollar index. We didn't really get into this with Carl Shimada earlier, but he does see prospects for a rally in the US dollar this year. US currency pretty flat today, but you can see it has been weak, especially against the euro over the past 12 months. And let's have another look at oil, see how it's faring. We keep hearing, of course, from oil industry observers that it'll take years to fix the mess in Venezuela's oil industry, which has been neglected and plagued with corruption. And also, there's an interesting story developing with geopolitical limitations and implications. The U.S. has seized a Russian-flagged oil tanker in the North Atlantic. Now, obviously, that's not going to delight the powers that be in Moscow. They boarded the ship. Russia said, we're monitoring this with concern. Of course, the other angle to that is Washington's continued failure to get the sides, Ukraine and Russia, to agree to a settlement of that tragic war. And finally, let's have a look at copper. What a run copper has had. It's been hitting record highs in London trading. And you can see it's taking a bit of a breather today. Nickel's been doing well. It's been trading at the highest in 19 months. We have those opening bells next. There are the opening bells on Bay Street and Wall Street. At the NASDAQ, Lyra Health is ringing the opening bell. In New York at the NYSE, it's Coastal South Bank shares doing the honors. It's time for the first 15. Let's check in on the TSX and the big US benchmarks. So the S&P 500 up in early trading into fresh record territory. The TSX down in very early trading, but remember it did close at a record high yesterday. So the market's doing just fine so far in 2026. The NASDAQ flat in early trading. One stock we're watching here is Zedcor. Zedcor, I think we might have the wrong symbol there. Should be, sorry, excuse me for a sec. I'm not sure. I don't think it's Zedcor Energy. Give me a sec. Zedcor Inc. We should be looking at ZDC on the Venture Exchange. We'll keep monitoring that one. There's Zedcor. Okay. Zedcor sells security cameras. Now, for parking lots, stuff like that, industrial lots. At the CES Electronics Show, Amazon has come out with a surveillance trailer priced pretty low, starting at about $5,000 US. And Stifel says that's a lot less than Zedcor's manufacturing cost, even for its mobile IZ units. And Stifel warning that we think that Zedcor stock will be very weak due to the company's limited financial history. It's hard to determine a support level for the share price. Stifel citing the competitive threat there. But in early trading, it looks like Zedcor not doing much, but it may still be a question of them matching up sell and buy orders. We'll keep an eye on ZDC throughout the day. Let's switch now to the egg industry. Cal-Maine Foods is the giant player in that commodity. It posted fiscal second quarter results that showed a decline as egg prices dropped. However, the full year adjusted earnings per share forecast was updated. And let's have a look. Another stock we're looking at is Albertsons, the big food retailer. Their sales were higher. And let's have a look at Constellation Brands, the booze giant. It is set to report later today. Look at the drop in the stock. And you do keep hearing reports and news stories indicating that in a lot of markets, people are turning away from booze. People are essentially drinking less. Okay, let's switch now to precious metals. Silver, let's have a look at it. We saw gold come under pressure today. Silver is down too after its incredible run last year. Let's get more from Lyle Stein, president at Forvest Global Wealth Management. Lyle, thanks very much indeed for joining us. What are your thoughts right now on silver? It's had such a run.
Yeah, silver has caught up to gold. Let's just put it that way. So we started the year at Forvest in our global investment committee discussing the whole precious metals trade. Gold was the star for the last 2 years, but silver and palladium and frankly even copper have shown much stronger movements in the second half of 2025. And a lot of that, I think, is the two factors. Number one, it's the industrial nature of silver. It's used particularly in photovoltaics. And then number two, it is kind of the high beta play. And that is important because you get the amplitude in the commodity as well as the stock when economies seem to be stronger. But what happened in silver most recently was the January 1st announcement by China that it is now a strategic mineral, and you're going to have to go through the same process to get silver out of China that you're going to do to get rare earth metals out of China. And that throws a real wrinkle into the whole EV photovoltaic world. And so silver's had a heck of a run, and the stocks in particular have gone parabolic, which is always a little bit of a concern for a market going forward.
One stock that I believe you like the look of is Sprott. Of course, they manage money. A lot of it is invested in precious metals. They have ETFs, for example, playing metals. You see decent prospects for SII?
Yeah, we've owned this as sort of a third way into the whole precious metal space. So you can buy the strict bullion, and you can buy the mining of the bullion. You can buy the streamers, or you can buy a company like Sprott, which actually takes a physical position in silver, gold, uranium, platinum, palladium. They have ETFs that hold physical. And so you're getting a leverage play that you don't get in the other names or the other sectors that I mentioned. So unlike a mining company, you don't have operating leverage, but you do get leverage to the fact that investors want to go and own this precious metal, and they can buy the ETFs that Sprott has. So you've got upside coming from the price as well as upside coming from the volume associated with having more holdings of these precious metals in terms of ounces or tons in the Sprott funds. And we kind of like that leverage, and it's been a nice place to get an alternative exposure to the run in precious metals.
On Venezuela, you think that Halliburton, the huge oil services company, and SLB, formerly known as Schlumberger, they could be winners here?
Yeah, this whole Venezuela thing is still in its very early, top of the first inning kind of way to look at it. But when you look at where the money's going to go, I mean, they're talking about having to spend $50 billion almost on an annual basis to get these wells and everything up into production. The good news is a lot of that money goes to Schlumberger, Halliburton, because this is the well service activities that they provide. And at the margin, that is what I think is going to drive the stock. Same thing with a company like Valero, which we actually purchased earlier this week on this particular news, because refining in the Gulf Coast now is a much stronger asset than it had been prior to the Trump administration's move on Mr. Maduro. So, the marginal dollars will now be looking for places in Venezuela where previously they might be looking in the Permian or in, even the oil sands of Canada, for that matter.
Should we be worried here if Venezuela does manage to ramp up production and steal market share? I shouldn't say steal, take market share for heavy oil in the U.S.?
I think you have to think that way. Again, it's a longer term trend, but at the margin, that is a very, very distinct possibility. The traditional spread between West Texas and Canadian Western sedimentary crude is going to get bigger as a result of what's happened. Now, the good news is we don't ship a lot of our oil to the Gulf Coast. The bad news is we do ship some, and the better news is that, again, it'll take time to adjust the refineries. But ultimately, we have a new source of crude in the world, which should be a negative for crude pricing in general. Again, who knows what's going to happen with China and Russia? But the fact of the matter is, I think the oil market is a bit disrupted, and the geopolitical activity, I think, was a bit of a shock. And so the question is, at the margin, will Canada, which took our production exports from a quarter of a million barrels to 3 million barrels a day, a big result coming from the slowdown in refining and production out of Venezuela, what's that going to happen? Or what's going to happen going forward? At the margin, we're going to be losers.
You've been looking at U.S. bond yields, the yield on the benchmark holding above 4%. What does that tell you, Lyle?
We come from a discipline that's called cost of capital. And the cost of capital ultimate benchmark is that 10-year Treasury yield. Now, the anticipation of the markets has been it'll fall with inflation, but it hasn't. And the reason the 10-year hasn't fallen as much as you might think is because of all the supply of U.S. paper in particular. Investors want a higher premium, a term premium or a real return, and that's keeping interest rates above 4%, which is competitive now. With a stock yield, S&P yields about 1.25%. You can potentially get a safer, higher yield in bonds than you could on an alternative basis. I'm not saying it's a great spot to be, but 4% is a very competitive yield, and it doesn't want to go down.
There are concerns. I mean, we just had Carl Shamata tell us earlier on the show that America is running wartime-style deficits. Will that eventually rise to the top of investors' minds, the endless red ink?
I think it is. It's a slow bleed, so to speak, Andy. It's taking its time. But ultimately, you can't run $2 trillion deficits year after year after year without some sort of consequences. And that's what I think the bond market is getting afraid of. At the same time, you've got a president who's asking for interest rates to go to 1%, which is a lot of liquidity into the marketplace, and their fears of inflation, let alone the fears of the higher real interest rate. So you put that all together, I think that's what's got the bond market rethinking its position and ultimately keeping that yield above 4%.
Lyle, thank you very much indeed.
Take care, Andy.
Thanks. Lyle Stein, president at Forvest Global Wealth Management. Coming up, the final tally is in, and Canada's biggest housing market saw prices fall by more than 6% last year. Even with lower interest rates and more listings to choose from, buyers in Toronto failed to return to Canada's biggest housing market last year in significant numbers. Prices were down in December. There was a total drop in prices of 6.3% for the year. Let's get more from Bloomberg's Ari Alstetter. Ari, great to see you. Fascinating, isn't it? The real estate industry, I seem to remember saying, yeah, lower interest rates will help, but they didn't show up in an improvement in prices anyway.
Yeah, this was supposed to be the year that Canada's real estate market bounced back, and Toronto's real estate market bounced back, and it just didn't happen. You'll remember that initially what drove the market lower starting in 2022 was a very steep rise in interest rates. And in the back half of 2024, interest rates started falling quickly, and people expected that to continue, and it did continue in 2025. And a lot of economists and market forecasters and people in the industry thought that's what it would take to get some life back into the market, but it just didn't happen. And there's no real mystery about why it didn't happen. It's that this year coincided with a trade war between Canada and its largest trading partner, the United States. U.S. President Donald Trump imposed tariffs on some key sectors of the Canadian economy. And even though the actual economic impact of those were relatively muted, the constant threat of more of potential escalation really kept economic growth pretty subdued. And when it comes to the housing market, it really kept potential buyers wary of making what's probably the biggest purchase in their lives. You're not going to do that, make that commitment to years and years of mortgage payments if you really fear that you might not have a job next year. And so that was the story of the year in Canada's housing market, story of the year in Toronto's housing market, and it's how it ended the year too, at least in Toronto. We'll get numbers from Canada later this month.
The weakness in Toronto, though, is a big part of that, the falling sales of condos and lower prices for condos, especially those infamous shoeboxes in the sky, the tiny units.
It's true. A sizable portion of the big buildup in inventory that Toronto has seen over the last year are from condos. And so that has been a particular problem in Toronto's housing market amidst this broader weakness Canada-wide. And unfortunately, it doesn't show any signs of slowing down at least this year, because condo buildings, the very tall buildings, at least in Toronto, and once they get started, you can't really stop them. It's like suddenly trying to turn off an oil tanker or stop an oil tanker. It has to keep going for a little bit, and so we still have many projects in Toronto that started during the boom year in 2021, 2022, and they're only going to complete this year. And so we're going to see more condo completions, and that's just going to result in more supply on the market, which is another big drag for Toronto's real estate market generally.
Ari, thank you very much indeed. Bloomberg's Ari Alstetter. And I hope he does some more of his investigative work as well. He's done some magnificent work, including some on concerns over mortgage fraud. Okay, after this, we are going to have more on the Prime Minister's plan to visit China next week, trying to rebuild bridges with the Asian superpower. That's ahead. The Prime Minister's office has confirmed that Mr. Carney will make an official visit to China next week. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and this is the latest that we're hearing from the Prime Minister's office, Andy. It's going to happen next week from Tuesday to Saturday, so that's the 13th to the 17th. Bloomberg is reporting that Mark Carney will not only make a trip to China, but will be meeting with Chinese President Xi Jinping, apparently discussing trade, energy, agriculture, international security. Obviously, relations between Canada and China haven't been great in the last few years. This is actually the first trip that a Canadian prime minister is making to China in almost a decade. Trudeau last went in 2017. But the idea here is to continue to reduce reliance on the U.S. when it comes to trade and, of course, rebuild relations with China. Those relations tarnished, you might remember, after Canada arrested Huawei executive Meng Wanzhou back in 2018. Remember all of that? And then that was followed by retaliation by China, detaining two Canadians, Michael Kovrig and Michael Spavor, and they were detained until Meng was released in 2021. So there was a lot of friction there between Canada and China. And Mark Carney has talked about making an effort to kind of rebuild those tensions. We know that in October, the two leaders met at the Asia Pacific Economic Cooperation Summit in South Korea. And it was there that Mark Carney actually accepted an invitation to visit China. So we knew that this would probably happen at some point. But now we're getting a firm date, and it's happening as quickly as next week. You mentioned trade talks. What will the focus be there? Yeah, I mean, China is Canada's second largest trading partner after the U.S. So I guess Mark Carney is making that focus on how important it is to rebuild those trade relations with China, particularly given what's happening with the U.S. And Mark Carney does have a goal to double his country's non-U.S. exports over the next decade. So this is part of that. Right now, Canada has import taxes on Chinese electric vehicles. That's a 100% levy, 25% tariff on steel and aluminum coming in from China. And in retaliation, China implemented a 75.8% tax on Canadian canola seed and a 100% tariff on canola oil, meal, and peas. That's been causing a lot of friction in the Canadian agriculture sector when we're talking about these tariffs. So I think that will be on the table, is potentially trying to lower these tariffs, work out a deal, just ease the tensions between the two countries. And obviously, Carney, he's been trying to do this for a while, and this is probably the next step in that process for the prime minister, but we'll have to wait and see exactly what happens. And again, Bloomberg is confirming that Mark Carney will be meeting Xi Jinping, but we're also getting reports that at this point, the prime minister's office itself has just said he's going to China next week to talk trade. So we'll have to see exactly who he's having meetings with. The body language will be interesting. The body language is always interesting when you get those body language experts talking about what everything means and just how tense it is. We'll have to wait and see. Thanks very much, Lindsay. Lindsay Biscaya. Okay, coming up, we are going to get some new numbers on the use of artificial intelligence in this country. Are Canadians really exploiting AI? We'll be right back. We have some numbers pointing to the use of artificial intelligence by Canadians, and some big differences in use are showing up across the country. We are joined by CTV's Renee Rogers. Renee, great to see you. Thanks very much indeed. Give us the big picture off the top, if you would. I mean, how prevalent is use of AI becoming in our lives?
Good to see you as well, Andy. Well, it's really been about 3 years since the so-called AI era began, and really that was with the release of ChatGPT by OpenAI in late 2022. And since then, we have increasingly been turning to this technology for things like, standing in for a friend, a teacher, a therapist, perhaps. And today we are getting a look at just how prevalent the use of this is and where people are using it the most here in Canada. So Nanos Research did a survey asking Canadians how often they use AI like ChatGPT, Copilot, Grok, and Gemini in their daily activities. These are what we like to call large language models. And 17% of respondents say they are using it every day. And of those, 6% are using it several times a day. Now, it is also worth noting, though, that 39% say that they never use AI, but that still leaves a majority who report that at the very least some use, even if it's just once a month or less. But really, this is providing a snapshot to us, Andy, of just how much this technology has become incorporated into our lives over the past few years.
And what about regional or demographic differences, age differences, Renee?
There are some differences. So when it comes to age group, this might not surprise you. The largest percentage of daily use was among those 35 and younger. So about 8 in 10 using that tech, close to a quarter of them using it every day. If we look at geography, the daily use was actually highest in Quebec at 8.8%, and it was lowest in the Atlantic, where over half of participants, or 54.5%, said they had never used AI. But there's no question here, Andy, that the use of AI is growing, and questions now being raised about how prepared Canada really is. There are concerns that, Canada is lagging behind other jurisdictions. For example, the EU, which just last year introduced legislation that is really becoming an example for the rest of the world. And, experts warn that if we want to be competitive, we need to catch up, because really the global digital economy is becoming increasingly powered by AI. Now, I did reach out to the Office of Canada's AI Minister, Evan Solomon. They say that Canada's new updated AI strategy is coming. We knew it was coming in 2026. Today, they say it will be coming in the coming months, Andy.
That's interesting. The maritime, the Atlantic province is generally older, as you know. The latest figures I've seen, more than 20% of the population 65 or over, whereas in Alberta, for example, only about 15%. So yeah, people are older in that part of the country. Thank you very much, Renee. Really appreciate it.
You're welcome.
CTV's Renee Rogers. Coming up, we got some ideas for your portfolio. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Prime Minister is set to visit China next week as his government tries to rebuild a relationship with the Asian superpower and cut Canada's economic reliance on the U.S. Carney is set to meet with the Chinese President Xi Jinping, with discussions focusing on trade, energy, agriculture, and international security. And this marks the first trip to China by a Canadian Prime Minister in more than 8 years. U.S. President Donald Trump says Venezuela will send up to 50 million barrels of oil to the United States at the current market price. Now, the cost would be about $2.8 billion US. Trump says the move will benefit both countries. This comes as a blow to China, which was previously a top buyer of Venezuelan oil. Venezuela has a backlog of unshipped crude since the U.S. blockade of sanctioned oil tankers was announced last month. BC Premier David Eby says Canada should prioritise building more oil refining capacity over new pipelines. This comes after Alberta Premier Danielle Smith called for a speed up in new pipeline infrastructure to the BC coast. Eby says the existing Trans Mountain pipeline is not at full capacity and could be expanded further. And let's have a look at the TSX. Now, you can see the TSX down from yesterday's record high close. Maybe we could pop up ZDC again. That's Zedcor, the maker of, among other things, surveillance cameras. Amazon came out with a cheap offering. Stifel said this does represent a competitive threat to Zedcor, Amazon's security trailer, starting at only about $5,000 US, with cameras to monitor a parking lot and things like that. We can see some selling in Zedcor right now. Let's have a look at the US market. The S&P 500 pushing further into a record. Having said that, and now it's in record territory again. Okay, bit of a metronome there. So it's at or near record highs right now. Let's have a look at the oil market. Despite this story that the Americans have now seized a Russian-flagged oil tanker in the North Atlantic, Moscow says it's concerned. Oil market investors don't seem discomfited. And let's have a look at gold, because gold has seen some selling, and we've seen a pretty significant drop right now in silver stocks on the TSX. We saw a big sell-off, for example, in First Majestic Silver. And finally, let's have a look at the Canadian dollar. And it's been holding in today at not far short of 72.5 cents US. As we move into a new year, it may be tempting to think, well, I'm going to buy the dogs of last year. Our guest says it might be best to stick with the winners of 2025. We're joined by Tony Sierro, President and Chief Investment Officer at Caldwell Asset Management. Tony, great to see you. Thanks very much indeed for joining us. So you stick with the winners. You say, for example, that Canadian banks and U.S. stocks still look good this year.
Yes, they do. Happy New Year, Andrew. Pleasure seeing you again. Absolutely. And why the Canadian banks? We look across the board last year, they went up about 30% or so, led by the Royal Bank. TD actually had a nice rebound. So if you bought the loser 2024, in 2025, you did quite well. But the reasons are, you got to start with the interest rates. Interest rates are coming down in Canada. There's been a hold the last time the Bank of Canada met, but the expectation is interest rates will continue to cut. And that's just going to improve the bank's loan loss provisions. Some of the issues the bank suffered a couple of years ago was when rates were higher, they're putting more money aside to potential bad loans down the road. And that takes away from the bottom line. Now, also with interest rates coming down, you start seeing a steepening of the yield curve, meaning your short-term rates are lower than your long-term rates. And that bodes very well for banks' net interest margin ratios, which is a key metric when we look at earnings on a quarterly basis. And why the net interest margin ratio increases? Well, banks, they lend you money long-term. When you take out a mortgage, it's 30 plus years. And when you invest with them, well, GIC, that you invest 1 to 5 years. So that spread on the yield curve that increases, the bank will make a premium on that. And finally, the wealth management division across all major banks here in Canada did quite well last year. And just think of it, that's the asset management division. And if investment assets went up 10, 20% because of market growth last year, well, you're just earning that much more of a spread in terms of fees for this year. So definitely Canadian banks continue playing that. U.S. equities, well, the economy is still conducive to growth. Low interest rates, tax cuts, and business spending conducive to growth. And you look at AI infrastructure spend, it continues to be prominent. And that eventually will add more to the overall economy. So yes, Canadian banks, U.S. equities, and I'll mention one more, gold. Gold did quite well last year, 60%, but there's no signs of any slowdown there. As the U.S. dollar continues to be weakened, a lot of pressure to weaken the U.S. dollar. And as you mentioned earlier, there's a lot ongoing geopolitical risk continuing out there. Investors do tend to flock to gold when that happens. So gold prices can continue to soar going forward.
What about the big AI names? What's your feeling there, Tony?
Yeah, there's two that we like and we continue to like, and they were sort of the laggards last year. So if you do want to buy something that's down in price or didn't perform as well, Amazon is our top pick. And when you look at Amazon, you have to look at the AWS, their cloud computing platform. I actually had somebody ask me the other day, what is cloud computing anyways? Major businesses, before computers, everything was paper-based and you file it away in a cabinet. Then they went to computers and you open up these double doors down the wing of the branch and these massive servers are behind these double doors with blinking lights and wire connections. So those are the servers that the data was stored for major corporations or many corporations. Now, cloud computing takes away from those servers. You don't need these servers anymore because you offload it to the cloud computing platform. And more businesses are going that route. And that's just going to bode well for cloud computing platforms like AWS and even Microsoft's Azure cloud computing program. Amazon as well, last year it did not do so well because of the threat of tariffs. They still have that e-commerce platform, the online retail shopping, that was affected drastically last year because of the threat of tariffs. The goods that you're buying are going to be increased in price because of the tariffs applied to it. But now that rhetoric has sort of been displaced. And let's see if that e-commerce platform picks up revenues again as more and more of us feel more comfortable going back and buying online.
Broadly speaking, do you think investors will look askance at Canada this year because of Trump's threats to our sovereignty? And of course, we're vulnerable on the trade front. We have a very open economy here.
Yeah, many views on there, and some wild views could be that, yeah, Venezuela is just a prelude that can continue out in the Caribbean. Then you look at Denmark with Greenland, and then potentially Canada because of our resources. I don't want to go necessarily down that rabbit hole. In the grand scheme of thing, with what Trump did in Venezuela, he ousted a dictator that was bad for the country. And that's why I think the markets have done well. Plus, there's some oil that freed up because of that. So the markets like that a lot. But let's hope it doesn't go down the rabbit hole like a lot of us are concerned about eventually taking over Greenland and then Canada.
Tony, thank you very much indeed. Tony Ciarro, President and Chief Investment Officer at Caldwell Asset Management. We've lots more ahead on the show. ATB Capital Markets is looking for modest growth, economic growth in this country in 2026. We'll have more when we come back. Our guest expects economic uncertainty to continue in Canada this year, especially with those renegotiations of the North American Free Trade Pact and Washington politics unpredictable, to put it mildly. He does think that economic growth in Canada will be limited at only about 1.2% for the year. We're joined by Chris Murray, Managing Director of Institutional Research at ATB Capital Markets. Chris, great to see you. Thanks very much indeed for joining us. So it is a bit of a tough prospect for us this year. Maybe not a drop in economic output, but lots of headwinds.
Yeah, certainly, Andy. And you know, we were thinking about, you know, when we started thinking about our outlook for 2026, really it was what was underpinning our thoughts around what we were seeing is not only the level of economic growth, but also a lot of the uncertainty that we've been seeing. You know, if you look back on 2025, when we got to April, we certainly saw that you know, there were record levels of uncertainty both in Canada and the U.S. with a lot of the tariff implementation. That has come to pass. But you know, again, in Canada, what we're going to see is the CUSMA agreement, the U.S.-Canada-Mexico Free Trade Agreement, open July 1. And right now, that has really protected a lot of Canadian industry. So we think that, that on the macro front, we're probably into a lot of uncertainty. So I think that's what's really going to be interesting is it's going to be, you know, a year where we think individual stock picking is going to maybe take over from, you know, kind of broader economic growth or index growth.
The Canadian consumer, is that a big part of your calculation here? People famously always feel the economy is worse than it is. We don't have an economy that's in a recession right now, it appears.
Right. And what's been interesting, and you may have heard the term the K-shaped type consumer profile. And what we're seeing is that, you know, for folks at kind of the top end of the income structure, things are great. You know, we're seeing lots of spending on what you can see, luxury goods, autos, travel, things like that. But if you're on the lower end of the spectrum, you know, what we're seeing is continued pressure on wages, you know, concerns about employment and the quality of employment, and even some of the consumer spending. So, you know, we've heard a lot of the commentary from some of the U.S. retailers that they're seeing, you know, maybe consumers trading down in certain cases. But in other cases, and I'm sure we'll talk about travel, a very healthy, robust travel demand. And again, like luxury vehicles have been, a bit of a bright spot amongst a tighter automotive market.
Well, speaking of travel, Air Canada is one of the stocks that's favored at your shop right now. What's the upside for Air Canada?
So we'll start with the fact that we've got a $32 price target and outperform rating on the story. But we believe that Air Canada is set to benefit very strongly from that level of travel demand that we're seeing, particularly from boomers, but also by Canadians who are looking to both travel internationally and even across the country. We're continuing to see good levels of business travel, and that's being borne out by a lot of the demand picture that we're seeing. And we think that, this year will be interesting as Air Canada introduces new aircraft that'll open up some new opportunities for growth into some different destinations that they haven't been able to previously serve.
Atkins Ray-Elise, the big engineering construction company, mostly engineering, I guess. Where's the upside there?
So I guess there's really kind of three pieces of it to think about. The first of it is really the backdrop, and you think about construction, both in Canada and the U.S., and a lot of the discussions around wanting to build in Canada. They're going to be a beneficiary from that. They also have the ability to participate in some of the growth in the U.S. and certainly organic growth rates have been very healthy. In the high single digits, and that's been, above normal for the last few years. And we think that that's likely to continue. But I think the other thing to think about is that Atkins is now at a point where it's going to play catch up to the rest of the industry. Historically, M&A has been a big part of the story. We think that becomes a bigger part of the story this year, as well as the fact that their underlying business continues to improve, and we continue to see that being a real positive. The other thing that's really special about Atkins is their nuclear business. They have the CANDU technology, but also exposure to a lot of the other sectors or parts of the nuclear infrastructure outside of CANDU technology, be that small modular reactors or services. And they've got a footprint both in Ontario and Canada. They're working with a number of the firms in the U.S. and throughout Europe and the U.K. And we think that nuclear is going to be a big driver over the coming years.
We've only got a couple of moments left, but NFI Group, the bus maker, you see upside there?
We do, and so again, you talk about individual stocks and focusing on what's gone right or what can go right. So over the last few years, NFI has been dealing with a lot of the echoes of the pandemic, but we're now set up, we think, for a very strong recovery in earnings. Backlogs are at record levels. They've got a healthy funding backdrop for what they're going to produce. They have the ability to produce on both sides of the border, so they're generally insulated around tariffs. And we think we're going to see very, very strong earnings growth this year. And we think that leads to a re-rating in the shares as we go forward.
Chris, thank you very much indeed. Really appreciate it.
Yeah, thanks, Andrew.
Chris Murray, Managing Director of Institutional Research at ATB Capital Markets. Up next, we're going to have today's ETF report, and we'll look at why the era of rock bottom fees on these funds could be coming to an end. That's ahead. The ETF report got a great story for you today. Now, it's focused on the US market, but often Canada, of course, reflects trends there. Bloomberg says that there has long been an ETF fee war, a relentless race in some cases towards zero, but that might be starting to look tired. One of the world's biggest low-cost ETF providers has begun to raise prices. We've got more from Bloomberg Intelligence ETF analyst Athanasios Sarafagos. Thank you very much for joining us. Very interesting. I mean, Vanguard, we're talking about, they were famous for near zero fees, and they are pushing up costs for investors.
They are, and yeah, good morning. Yeah, it kind of goes kind of against everything we've been taught about the ETF industry, but Vanguard's gone through some leadership changes last year, and of course they're still very, very cheap. It's not to say that all of a sudden prices are going to go up, but I think the industry's reached this saturation point. You can buy an S&P 500 ETF for anywhere from 2 to 3 basis points. Wow. That's pretty much the floor. So now issuers that are coming out, they're saying, well, I can't compete with this. I cannot compete with Vanguard at 2 basis points. We're going to start raising prices. But to do that, they're also offering things that are much more differentiated than the S&P. And then Vanguard as well, they're starting to launch active ETFs, starting to launch things that are just maybe not necessarily things that go into your core. So I think this is a really interesting signal that, yes, okay, you can still buy cheap stuff, but if you're going to start buying satellite positions or anything else on the fringe, those prices are going to start to go up.
It's interesting. Yeah, inevitably an industry will try to push up fees. There's one twist here. I'm not sure if this has shown up on your radar, but apparently ETF providers, they do make money lending stocks to short sellers. That's a source of income. So they don't just have fees as a provider of profits.
Yeah, that's correct. And so there's actually some ETFs that have a 0 fee. So to you, the investor, you're not paying anything, but the condition is that the issuer can keep the SEC lending revenue that they make. Right. Now, some have different policies. Some will give some of that lending revenue back to the investor. Some will keep it. But still, at the end of the day, you're still really getting some very, very cheap exposure to pretty much any market you can think of. But yeah, it's not just the headline fee. They do try to sort of monetize it other way, just because it's such a brutal industry. Like collectively, all the issuers, 200 plus, make about 23 billion in revenue, which might sound like a lot, but when you compare that to, say, mutual funds or hedge funds, it's really just a fraction of what the potential revenue you can make in another wrapper.
Yeah, it's interesting. And we're looking at, average ETF fees edging up. Partly, though, I think you referred to this, that the industry is launching these so-called active ETFs, moving away from the original pure passive concept. You have an interesting thing. This I had not heard of, that BlackRock has figured out how to make money off beta with ETFs. Can you explain that, please?
Sure. So between Vanguard and BlackRock, the 2 largest issuers, Vanguard's very unique in their structures. They're set up as a mutual structure. So basically, any money that comes in goes back to the fund holders, which just brings down the cost. BlackRock is publicly traded, right? Obviously, they even though they have very similar fees to Vanguard, they're much better at launching other products alongside those core offerings that actually can make them some money. So we actually look from a revenue perspective, they're much more potent than Vanguard, even though just having basically the same amount of assets in the industry. So I think their Bitcoin one is a perfect example. They launched that a couple years ago. It's now their most profitable ETF, and it's still only 25 basis points, which is still pretty cheap compared to other ways you can get exposure to Bitcoin. So BlackRock has just figured out a much better way to sort of monetize some of these ETF strategies, as opposed to Vanguard, who's just like, hey, we're going to be really cheap. We're going to give back everything to the fund holders, as opposed to keeping it for ourselves.
That's interesting. Yeah, I mean, I'm remembering that Vanguard was essentially for a long time almost a non-profit entity.
Yeah, it really kind of is. So that's why it's such a brutal industry, because not only are they cheap, but it's forcing other issuers to have gotten cheap too. But again, I think now we've sort of reached that saturation point. There's only so much you can do. There's only so low you can go. So the new issuers that are coming out, they're actually just learning to live alongside Vanguard, saying, hey, I know I can't take that money away from these core offerings, but I can offer you things that are a nice complement to that. And because it's usually a smaller slice of your portfolio, you can charge a little bit more. It's not felt as much as saying the core of your portfolio being in a more expensive product. So that's really sort of how the industry is starting to pan out. It's much more of a barbell. You have Vanguard on one side, and you have sort of the high octane, very differentiated players on the other side.
Athanasios, thank you very much indeed. Athanasios Sarafagos, Bloomberg Intelligence analyst. Fascinating story there. Coming up, your latest headlines and markets. The Prime Minister will visit China next week as his government tries to rebuild a relationship and reduce Canada's economic reliance on the US. Carney is set to meet with the Chinese President Xi Jinping, with discussions focusing on trade, energy, agriculture, and international security. This is the first trip by a Canadian Prime Minister to China in more than 8 years. Home sales across Toronto saw a decline in December, along with the average selling price. Data from the Toronto Real Estate Board indicates that sales dropped 0.4% month over month, while the price of a home was down 5%. Annually, sales dropped more than 11% as buyers failed to return to the market, despite lower interest rates and more listings. The board says economic uncertainty weighed on the housing market throughout the year. Warner Brothers says an amended takeover bid from Paramount is inferior to the deal it already has with Netflix. The entertainment giant is urging its shareholders not to tender their shares to Paramount. Warner also says the terms of debt financing and other terms put out by Paramount heighten the risk of failure to close the deal. And there's a look at the North American markets. The S&P and the TSX both slipping from yesterday's record high. Just wondering what is dragging Toronto down. We do, of course, we have seen some selling in precious metal stocks today, particularly silver miners. We saw some weakness in gold. Heavy traders in Toronto right now. Toronto Dominion Bank slipping, but Scotiabank up. CNQ down. We have seen some fresh weakness in oil prices today. One group of stocks that's interesting, a recovery here lately in Magna and Linamar. Both of those names hitting their highest in at least a year in trading today. Now, we are awaiting Aritzia number, so look at the run up there in Linamar. We are awaiting Aritzia numbers tomorrow after the market, according to my Bloomberg screen, and that stock hitting a record high today. Look at that, the run up on a perception that the company is thriving in the United States as well as in Canada, and of course it's growing in that part of the world. Another stock popular with investors right now, Algonquin Power, the electricity seller. That stock hitting its highs, maybe AQN, if we could put up a 5-year chart. You pick up a yield of about 4% on Algonquin Power. The stock hitting its highest in at least a year, but you can see still substantially down over the past 5 years. Let's have another quick look at gold, because gold wobbled a bit this morning. You can see slightly down. Barron's thinks that investors are, quote, beginning to put geopolitical concerns on the back burner, even though the Americans just seized a Russian-flagged oil tanker in the North Atlantic. But you can see declining demand for gold right now among investors. Coming up, we're going to tell you more about that Russian-flagged vessel that has been boarded by U.S. military and Coast Guard personnel. And there's a look at oil. You can see oil down despite that headline. Right, so we got a story with lots of angles here. The Americans have seized an oil ship, an oil tanker, that had a Russian flag on it. In fact, reportedly, the crew had even painted the Russian flag onto the hull. They've been going after this ship, though, for a while. It was apparently originally intended to carry Venezuelan oil. Let's get more from Bloomberg's Al Nightingale. He's the team leader for oil trading in Europe. Al, give us the latest here, please.
Hi, it's exactly as you said. The US forces have seized a tanker with a Russian flag painted onto its hull. Before it left that area. It was kind of a flagless vessel, and the US has a warrant for it. And it has now carried out this seizure in the North Atlantic, so kind of between Iceland and Scotland, which is obviously a huge distance.
So this ship, can you clarify, it was on its way to Venezuela to pick up oil? Was that the plan, and then it turned back?
That's right. It was an empty ship. As you may recall, there was a blockade on sanctioned vessels announced by the US administration. So that prevented some from leaving, and it also discouraged some from going there. That particular vessel turned away, and then it got essentially followed by a US Coast Guard vessel all the way to the North Atlantic, culminating in what's happened today.
Russia had sent a submarine to help escort this vessel, but fortunately, there doesn't seem to be any kind of a clash involved. But Moscow saying it's concerned.
That's right. I mean, from a Russian perspective, you've had, for example, Ukraine attacking some Russian vessels in the Black Sea. There's this seizure. Venezuela is obviously an ally, and the blockade is, hurting an ally. The seizure of the capture of Maduro is hurting an ally. So this is just another thing that is, let's call it problematic for Moscow. So yeah, they said before the seizure of this vessel happened that they were concerned about the precedents that were being set, I suppose. The vessel. It's true that the vessel was in international waters, and it's pretty unusual to seize a ship in high seas like this.
And what is the justification the Americans are giving? This ship was already under sanctions, was it? Because I think it had been linked to oil that would end up sending money to Hezbollah, the terrorist group.
That's right. So before the Biden administration left office, they sanctioned a whole bunch of vessels. I'm pretty sure it's over 100 vessels, and many of those have been, also involved in the Venezuelan trade. This being one of them, and that's what the issue was. That's the cause for it, having been sanctioned. This particular vessel. There's another vessel that is. That was sanctioned for the Iran trade, and this one wasn't done in January, but lots of them were. This one was tied to the Iranian trade, and that's why it got seized.
It's interesting that the oil market, there's always a multitude of factors affecting the oil price, obviously, but with oil down, the market doesn't seem too concerned about this geopolitical story.
The oil market has become pretty hardened to geopolitical stories. It's always looking for what actually affects supply. Does this affect supply? It doesn't, not immediately. And until you see something where you can very clearly connect the dots between a geopolitical action and a supply consequence, the market kind of, maybe it reacts a buck here, a buck there, and then it quickly gets a bit bored and moves on to something that is kind of important for supply. This is a market that is looking pretty oversupplied right now. There isn't any sign that we're going to have a problem with Venezuelan supply in the immediate term, and in the longer term, it may well end up boosting Venezuelan supply. So, if you're being cynical, what's the problem? Traders are pretty cynical. They're looking for what's really going to be impactful, and they're not seeing it.
Al, thank you very much indeed for joining us. That's Bloomberg's Al Nightingale. Coming up, we got hot picks in pharma, and there's takeover talk affecting one of the names. We'll be right back. time for hot picks in pharma now. Our guest does have Eli Lilly as one of its selections, and there's talk that company is negotiating to buy a California-based biosciences company. We'll get to that shortly, but let's get to our guest first. Evan Seigerman, Managing Director at BMO Capital Markets. Evan, always great to see you, and thanks very much for joining us.
Thank you for having me, and Happy New Year.
Happy New Year to you. Can we start off with another name? It's familiar to us, of course, Gilead. Remind us what Gilead does these days. What's its main franchise, and why do you like the stock?
Most definitely. And so Gilead is the leader in HIV treatment and prevention. We are very bullish on their long-acting prevention asset called Yeztugo. We also like that they are making really good headway in the cell therapy space. So these are cell treatments to treat blood cancers. We think they're going to be very competitive in the multiple myeloma area, kind of competing against J&J and Legend's Carvykti, potential approval later this year. So beyond kind of the fundamentals of the company, and they also inked a deal with the Trump administration late last year, kind of taking some of investors' fears off the table regarding MFN pricing, or most favored nation pricings, for their HIV business. They have a lot of capacity to do transactions. I think that they've really done a good job of cleaning up house, tightening up their P&L, looking at their expense base. And I think that they are in this growth mode and can execute very well into the end of the decade, driving superior returns.
And HIV is still a big enough problem for a company to make money from medications in this area?
Great question. Yes, it is. There are millions of people living with HIV globally. And beyond that, they are working to prevent new HIV cases. So that's really what's key. They have a long-acting product called Yeztugo, I had mentioned, and we believe that's going to be the market leader. So we see strength in that franchise into the 2030s.
Your next idea is a company called Disc Medicine. Its symbol is iron, I-R-O-N. Tell us what's their main focus.
Great question. So this is one of our biotech picks. The reason why their ticker's iron is because they deal with the blood, hemoglobin, and iron, kind of a little play there. But why we like Disc Medicine? So they were a recipient of the Commissioner's National Priority Review Voucher. So one of the special priority review vouchers given to kind of assets of high unmet need for a drug called bitopertin. Could be approved this month. They had some really good phase 2 data. And for a small biotech company to have an approved asset, 3 or 4 years after they kind of did the reverse merger is really impressive. Beyond that, they have a drug looking at anemia associated with a blood disorder called myelofibrosis. Competitive space, but we really like what they see. So the key here is small biotech company with multiple shots on goal, and that's a unique feature among kind of the universe.
Let's get to Eli Lilly, and maybe can you talk to at all about this news from the Wall Street Journal that they're in talks to buy an outfit called Ventyx?
Most definitely. So we put out a note yesterday, so I'm happy to talk about it. Ventyx Bio is a smaller biotech company. I think the deal kind of in the journal had suggested about $1 billion. So not a huge number for Lilly, right? They have almost unlimited capacity to transact. But what this would get Lilly is a host of small molecule drugs for various inflammatory diseases like ulcerative colitis, Crohn's, other diseases kind of in the cardiovascular system. They also have a drug that allows for inflammatory control in the brain, potentially for Parkinson's disease. So higher risk, high reward. It seems like they're buying a platform and assets that they think they can take potentially forward. May not all work, but really highlights Lilly's focus beyond obesity into the inflammatory space.
Lilly generally is a stock you like, is a big driver of that, the GLP-1 drugs?
Most definitely. I mean, we still believe they are the leader in the GLP-1 drugs. Their lead asset, Zepbound, is the best in our view. We also highlight that their small molecule oral orforglipron likely approved at some point in the first half of this year. Going to go toe-to-toe with Novo's oral Wegovy. A lot of focus on that. But what's key here is we see Lilly continues to execute and provide, create products for all patients kind of on the obesity spectrum, from the lower efficacy, think with orforglipron, all the way up to a drug called retatrutide for patients who really need, rapid and sustained kind of deep weight loss. We also like that they have assets outside of obesity, kind of unlike Novo Nordisk, or really where they're focused. Novo is really just focused on obesity and diabetes. They have other assets. But with Lilly, they have oncology, neuroscience, inflammation, and that diversity gives us comfort in their broad business.
And can you just update us, have these GLP-1 drugs that you just take a pill for, are they actually on the market now? Because I know the industry's been desperate to get them out there.
Great question. So in late December, right ahead of Christmas, FDA approved the Wegovy pill, so the semaglutide Wegovy tablet. And Novo earlier this week announced availability. They are starting via the cash pay channel. I think in the United States, the low dose is $149 a month. Not available kind of outside of the United States, but a lot of focus there. One other thing I want to highlight, I get a lot of questions on the potential for a generic semaglutide in Canada. We got some reports that there are delays for potential approval because of some manufacturing issues. So we're closely watching that. Could come later this year, but could even be delayed beyond that.
So it's semaglutide. It's not semaglutide. Yeah, I thank you.
Tomato.
I know, I'm going to go with what you say, Evan. Why not? Thanks very much. Before we let you go, because we love hearing your insights on drugs, what else should we look out for in 2026? Is there a big event coming for investors, do you think?
Great question. I think there's going to be a lot more M&A. Obviously, we had the news of the potential news of Ventyx and Lilly, but a lot of the companies that I follow, the big biopharmas need to buy. So Merck, Bristol, Lilly could buy the European pharma companies. We know Novo is going to buy. All these companies need to add to their portfolios, which is great for the small biotech kind of ecosystem, which is why I highlighted Disc Medicine. And I think that is going to be a key driver of this space going forward.
Thank you very much indeed, Evan. Great hearing from you.
Always a pleasure.
Evan Seigerman, Managing Director at BMO Capital Markets. A New Brunswick cabinet manufacturer is hoping to maintain U.S. business relations after U.S. President Donald Trump announced tariff delays. CTV's Laura Brown filed this report.
It was the last few hours of 2025 when kitchen cabinet manufacturer James McKenna received some unexpected but very welcome news.
We were extremely surprised, did not expect that it was happening, and greatly relieved. So first thing I did was got a hold of my U.S. customers, reached out to them and informed them of Trump's decision not to increase by 25%.
Upholstered furniture and finished wood products like cabinets and vanities were hit with a 25% tariff in October. U.S. President Donald Trump promised to increase it to 50% by January 1st. But in the 11th hour, Trump announced he would delay that move until 2027.
I think we can handle a 25% increase. Our U.S. customers are going to absorb half of it, and we're going to take half of it. At 50%, that would completely eliminate any chance of doing business with the U.S. And we've seen in December a drop off in sales already, a drastic drop off. Probably 50% of our sales in the U.S. have already gone away.
It definitely was a welcome relief, not a solution for us. As you mentioned earlier, we were hit October 1st with 25%, and in a manufacturing environment, that's very difficult to absorb.
There are no plans for layoffs at Glenwood Kitchens. James McKenna is hoping to find new markets this year and keep the ones he's already got in the States.
It's very difficult for us to plan our business. That's why, as a company, we're actively looking at business outside of the U.S. to try and recoup the loss, to grow our business. And if the U.S. business does come, that means we're all the better.
Laura Brown, CTV News, Fredericton.
U.S. President Trump has vowed to rebuild Venezuela's energy sector. Meanwhile, many are calling for Canada to ramp up energy exports. CTV's Rachel Aiello has more in this report.
The Prime Minister is facing new pressure to ensure Canadian oil remains competitive in light of U.S. President Donald Trump pledging to rebuild Venezuela's energy sector.
we're going to take back the oil that, frankly, we should have taken back a long time ago.
Asked what impact this could have on Canadian exports, Mark Carney said while a functioning Venezuela could eventually produce more oil, his government is working to expand domestic access to new overseas markets.
We welcome the prospect of greater prosperity in Venezuela, but we also see the competitiveness of Canadian oil, and we're investing, or we're putting in place measures so that that's going to happen.
Carney's remarks came after Conservative leader Pierre Poilievre called for him to rapidly approve a new West Coast pipeline. In a letter to the Prime Minister, Poilievre said every barrel the United States sources from Venezuela could mean one less barrel these refineries would buy from Canada. Though experts say it will take several years and major investments before Venezuela could outpace the 4.5 billion barrels of crude that Canada produces per day.
So while there's certainly potential to change the kind of medium to long-term oil market, it's still a less favorable place to do business in Canada.
Alberta Premier Danielle Smith says the events in Venezuela emphasize the need to reach new buyers with new pipelines, while BC Premier David Eby said he disagrees.
That's Rachel Aiello, our colleague at CTV News. Let's check out the markets. The TSX hit a record high yesterday, now down about 1%, but still what a run it's had over the past year and more. Some stocks on the move in Toronto. Algonquin Power got an upgrade at National Bank, hitting briefly at one point anyway, the highest level since May of 2024. National moving the stock up to outperform from sector perform, saying that its rates, utility rates, are likely to be approved by regulators. And so that stock moving up. Capital Power, another electricity seller, also higher, almost 4%. Bausch Health, another mover to the upside right now in Toronto. Reportedly, an analyst at Truist Securities sticking with a hold on BHC, but raising the price target from $7 US to $8. So the market seems to like the sound of that. Some stocks, though, that we've seen under pressure. Capstone Copper down pretty sharply. Of course, this is a decent time to be in the copper business with prices at or near record highs. I'm just trying to work out, they had this strike in Chile. I forgot about that. And the talks apparently, reportedly, have ended without a deal. The strike by those miners in Chile extending into a sixth day, according to the union. There also was a big block trade of about 3.5 million shares at $14.10. Anyway, Capstone under pressure. And there's First Majestic Silver. I mentioned it earlier, and down in common with Endeavour Silver. And silver's had that incredible run, and it's certainly dropping. Both platinum and silver seeing declines right now. Apparently, there have been sales from index reweightings, and there's also talk of potential U.S. tariffs, a highly volatile market, though. And spot platinum sliding north of 7%, silver down as much as 5.7%. Okay, a couple of stocks we're watching. Dye & Durham, the software company, watch out there. They're set to report after the bell. And we're expecting, according to my screen, Aritzia to report tomorrow. That stock hitting a record high. Thanks very much for watching our show.